Today's session is regarding Keynesian macroeconomic theory and the Keynesian approach to economic analysis. Let's get started with today's session. John Maynard Keynes revolutionized how many people view the economy. During the 1920s to the 1930s, Great Depression timeframe, the economy was not improving and was not recovering as many classical or many traditional view of the economy expected. And Keynes published his famous book, The General Theory of Employment, Interest Rates, and Money, during an important time that revolutionized the economic perspectives and economic view of the economy. This came during a time of the Great Depression when the world experienced the worst economic crisis in history, with the exception of the 2008-2009 financial crisis, and also the most recent one, the COVID-19 pandemic, that shut down world economic activity. But John Maynard Keynes had different views of the economy. His approach were different. During economic hard times, he believed that there were certain things that needed to be done in order to stimulate the economy. Let's take a look how John Maynard Keynes saw the economy and criticized the classical perspective of economic activity. The Great Depression years were rough. During the 1920s to 1930s, there was significantly high unemployment that lasted for 2 to 3 years or more in some cases, over 20%. In some cases, it was about 25 to 28%, even higher, depending on the demographics. There were certain economic hardships across the nation. Banks collapsed, businesses closed down, people had to sell their belongings, people had to sell all of their stuff in order to keep their day-to-day activity. And many were expecting the economy to improve within the market forces, and that didn't happen. The employment plummeted. The Say's law and the classical laissez-faire perspective of leave the economy alone, the economy knows best, didn't hold. The economy was not improving, and it lasted for 2 years and even longer. Great Depression is referred to as 24 consecutive months of low economic activity. And no one had experienced that particular situation prior to that degree. Imagine now if this crisis will last for 2 years. The full shutdown when we were like in May or April, shut down for 2 years. It created a lot of significant issues for many families. The economy needed some form of public policy intervention. So a lot of things were happening during the Depression years. Many of us were not alive at that point, but we have lived through one, which is the COVID-19 crisis. And it has actually put into perspective what economic crises really are about. High unemployment, bank economic hardships, families collapsing, financial hardships, and so on. So Keynesian economics was introduced to view the economy differently than the classical perspective. So here we have the Keynesian view of the economy, and actually his view on Say's law. Say's law, if you recall, is specifically specifying that the relationship with interest rates and investment, and how there's a direct relationship, the savings lead to the same amount of investment. Keynesian, according to Keynesian economics, a decrease in consumption and a subsequent increase in your savings, if you're not consuming, you may be saving, may not always be equivalent. And it may not always equal an equivalent increase in the amount of investment. So therefore, the total expenditure may actually be different. Say's theory was an increase in savings may increase the level of investment. If you save $1,000, you will invest $1,000. Keynesian was a little bit more critique, more applicable to things that could happen. If you save $1,000, you may not necessarily increase investment by $1,000. There are other different factors. So here we have the total expenditure model on the right side, on the left side of the screen. Total expenditure is $5,000. Out of those $5,000, $3,000 come from direct consumption, $600 come from investment, $1,200 come from the government, and $200 come from the international sector. So saving increase here by 100, so the consumption should decrease by 100. If you save 100, you're not consuming 100, right? The rationale. According to Keynes, the additional $100 in consumption may not always lead to an additional $100 in investments, because there could be other factors that savings could be used for. So suppose here that investment, instead of going up by 100, it actually goes up only by $40. by $40. So there will be a mismatch between the Keynesian view, which is the savings do not always lead to an increase in investment, and the classical view that was specifying that yes, you will increase investment by the same amount level of savings. So notice that on both sides, the left and the left of the screen, total expenditure at 5,000, it's different than the total expenditure at 4,940. That means that if your consumption has declined here by $100, your consumption declines by $100, which was here on 3,000, your investment is not going to go up by $100. It's going to only increase by a small amount, which is $40. So there's going to be a mismatch between how Keynesian view the actual increase in investment from the savings and how the classicals view savings stimulating investment and so on. So Keynesian started approaching the economy from different lenses and different perspectives in terms of how the economy can actually function. So we have the classical view and the Keynesian view. The classicals have a different perspective on interest rates and investments. Keynesian's view have a different perspective on the investments and the interest rates and how the economy functions. Let's take a look at the differences between the classicals and the Keynesian economic approach. Classicals believe that savings is directly related to the interest rates, and therefore it affects the level of interest rates that can stimulate investment. Keynesian specifies that there are important factors that help determine investment, and one of them is interest rates. The classicals view specified here that as the interest rate goes up, savings rises because people want to save more to attract greater rate of return on the interest rate. And as the interest rate drops, savings decline because you get less interest rates on your savings, and vice versa. So ceteris paribus, everything else is the same. Keynesian was actually more practical. He said, well, we need to consider the interest rates, which is part of the classical view, similar perspective. But they also said we need to consider the expected rate of return or rate of profit on our investment, because that's part of the reason why investment takes place, to receive some form of expected return or expected profit as part of the consideration, not just savings and interest rates. There's more to the story. And also the expectations about economic activity and investment returns. So you need to consider your interest rates, you need to consider the expected profit, you need to consider the expectations of the investment taking place in the economy. So it's a complete picture, a more practical picture that is applied today. You invest expecting some form of return, and you consider the funds that you're borrowing and the interest rates. So Keynesians here have a perspective on business expectations could be optimistic and can be pessimistic. If they're pessimistic, then investment is unlikely, even though the interest rates may be attractive. So regardless of how the interest rates may be, if you have pessimistic views of the economy, investment may not take place, which adds on to the more elaborate view of the economy rather than the classicals, which had a direct relationship with savings, interest rates, and investments. The Keynesian and the classicals view the economy differently. So sometimes people ask, what is your view of the economy? You have a Keynesian view, a classical view, or a conservative view, etc. We have the most two traditional schools of thoughts, Keynesian economics and classical economics. Keynesian economics considers that employees and labor unions will resist any effort to cut wages. And if you recall, the classicals believe that wages are flexible. If the economy drops, there is the possibility of wages to decline. Keynesian economics said no, wages are not going to decrease. With the classicals, wages are flexible. So Keynesian believes that both wages and prices are inflexible, downward, meaning that they're not going to drop. If anything, they increase. Wage rate has increased historically. The price level have increased historically. They stabilize and then increase. So Keynesian says no, the economy will not provide low wages and will not decline the prices. They're inflexible downward. And he specified that during recessions, the economy does not self-correct itself soon enough, or the recessionary gap does not close itself on its own, something else needs to be done, which is a direct critique to the classicals that specifically specify, leave it alone, the economy knows best. Keynesian says no, the economy doesn't know best. Sometimes recession gaps don't close on their own. Something else needs to be done. And the example was the Great Depression. Everybody was expecting the economy to recover, and no one had a solution then. The economy does not self-regulate sometimes. It takes a long time, and if anything, it could take a long time for the economy to recover. So therefore, the economy requires direct government intervention to stimulate the economy through adequate public and fiscal policy and economic policy to stimulate the economy during an economic hardship, or to slow down economic activity if it's inflating or accelerating. The classicals specifically stated that if we have a crisis, if things happen, employers can cut wages and can adjust labor through the wage adjustment process. And wages and prices are fully flexible and will adjust to the market. Well, it was actually tested during the crisis. And if you think about it today, prices didn't really drop for a lot of different things. Like sometimes prices adjust when companies have developed different products already in the making, but prices are pretty stable and wages are pretty stable. Recessionary gaps, according to the classicals, naturally adjust to the natural adjustment process of the economy, and unemployment will naturally self-correct and reach the normal rates according to the classical perspective. And the classicals believe that the economy can self-regulate itself, and heal from an economic contraction, economic downturn, and the economy knows best, the market knows best, so leave it alone. Laissez-faire economics. So in this model, we have the economy getting stuck in a recession. So we have Q1 represents the real level of GDP, and Qn represents the potential GDP, and they're represented by the long-run aggregate supply curve, the green one, and the aggregate demand curve, it's the red curve, the aggregate demand in the economy by consumers, investors, government, and the short-run aggregate supply, which is the production of goods. If the output is approaching zero and is less than potential GDP, the economy is in a recession and we have a recessionary gap. And according to Keynes, if the economy is in a recession, which is below natural levels or below potential levels, this particular gap will not close on its own. According to the classicals, they said, well, wages will decline and the supply of goods will increase by the productivity side and the adjustment process on the wages and the price level. Keynes actually critiqued that perspective, that the economy may be stuck in a recession and this gap is not going to close on its own. Wages are inflexible, prices are inflexible, and something else needs to be done in the economy to stimulate the economy during a crisis. So gaps, recessions, don't always close on their own. Sometimes they do, but it could take a long time. And the economy, families, businesses cannot wait a long time for the economy to recover. So we need to question the classical position on the self-regulating economy. In often cases, we notice that businesses may follow efficiency wage model perspectives, which means that it's in the best interest of business and firms to pay their workers and their employees efficiency wages that are higher than the equilibrium rate. Think about major companies like Starbucks, Costco, In-N-Out, or all of the companies that traditionally have paid their workers a little bit more than the minimum wage to provide good customer service, a good productivity, or to simply for good visionary perspectives of the company. So he introduced often this perspective that sometimes businesses may be in the position, or it's in the best interest of them to pay more to their workers to get the most out of them in the productivity sense, or simply for efficiency matters. So he was stating here that wages might not be downward adjustable, inflexible downward, at least for some time. And if they are flexible downward, then the self-regulating economy is in question, because it will throw off the classical perspectives in terms that wages drop, wages decline. And if anything, wages are slowly increasing or stay stagnated, and so on, but they rarely decline. You can argue that the real purchasing power of your wage is declining according to the price level, but for the most part, prices may increase in some situations. So Keynes argued that the economy could stay in a recession for a long period of time and get stuck there if something else is not done. We cannot wait for the adjustment wage process, the economy to self-regulate, the invisible hand to work its magic around the economy, or for the natural correction process. So it needed more of a fiscal policy, public policy, economic policy, and that's when Keynesian economics started to take a major effect. Most economies now in the world follow Keynesian economic approach in terms of economic activity. So within this model, we have the following labor market, which is represented by the wages on the vertical axis and the number of workers on the horizontal axis, the supply of labor and the demand of labor by the firms. So we're going to start with the demand for labor with D1 at equilibrium 1, and the supply of labor, S1, and the wage of labor at wage number 1. So here, currently we have wage labor 1, quantity of people employed 100. If the demand for labor declines, which is shifting to the left, notice how the demand for labor declines is indicating a new equilibrium with a lower wage at wage 2 and less people higher, which is 75 units at the lower wage. This model is indicating that if firms demand less labor, they're going to demand less labor and pay them a lower wage, according to the wage adjustment process. However, this is not always the case. Not necessarily will employers pay lower wages. It doesn't happen in the economy. So in my perspective, and according to most perspectives from different economists, wages are inflexible downward in the short run. They're inflexible. And the reasons may differ. There's long-term contracts that are set in place. There is a minimum wage requirement in different states. There are unions that keep the wage at a certain rate. So wages are sticky. They are inflexible. Instead of going to the wage number 2, which is at 75 workers, the wage stays the same and the firm hires less people, which is essentially 60 people, which is a lot less than wage number 2, and they still pay them wage 1. So wage stays the same. Eventually, in the really long term, wages could drop if the economy doesn't improve. So there's various reasons why the wage can stay the same. And again, I mentioned several, but the wage is sticky or inflexible downward according to the market. So how long does it really take for wages to adjust if they do adjust? It could take many years. Sometimes people agree or disagree whether or not wages are inflexible. Today, many people, including myself, may take the position of either Keynesian or classical perspectives, and you still have people that believe that the market knows best. The free market promotes economic activity, so don't intervene, leave it alone, don't even have government activity. But I can argue that most economic policies today are Keynesian to some extent. So the question is not whether or not the wages, if we're looking at wages only right now, and prices are flexible downward, it's just how long are they going to take to adjust. It could take a long time. The economy could take a long time to recover. Think about it, if we wouldn't have received the stimulus fiscal checks to the public that were given to the public earlier this year, and they would just sit it out, wait it out. Well, families, people were laid off, businesses were closed down. It could take a long time. And that's just an example of real economic event. Here we're looking at the wages situation. Something else could happen. The COVID-19 is not related to the business, it was something else, but it could really take a long time. So if they do adjust downward, here we have the supply of labor and the demand for goods and services by the aggregate demand, means that if the wages drop, firms can increase the supply of goods because there's low wages, they can supply more output at a lower cost, and the price level would drop and the economy will go back to natural levels in the long run, and the economy will naturally adjust. So here we have the wage rate dropping from $10 an hour to $8 an hour. The wage drops, the price adjusts, and the economy closes the recession. If it really happens like within a week, 2 weeks, 3 weeks, if everybody was flexible that way, it could close the recession. But if you think about California's real minimum wage now is $15 an hour. They're not going to drop it to 10, and they're not going to drop it to 8. So wages it's questionable whether or not they're inflexible downward. And we're not always going to have low prices. If anything, businesses want to charge higher prices for goods and services, and workers or firms or unions will always be asking for stable wages or higher wages. So the simple question is which position to take. Well, it really depends on the economy. Most of the time, if the economy is doing well, leave it alone, stimulate it, and don't intervene. That's a classical approach. If the economy needs intervention, then you can take a Keynesian approach. So we're going to analyze a consumption function model that was introduced by Keynesian, or the Keynesian view of the economy through the consumption function, which illustrates the relationship between the level of consumption of goods and services by consumers, households, an individual household, or the aggregate households, and the disposable income of that person. So your consumption of goods and services is represented by this consumption function. We have consumption, C, by a household or individual is equivalent to CO, your autonomous consumption, plus your marginal propensity to consume times your disposable income. Now, what does CO means? Consumption autonomous consumption. Your consumption that is autonomous means that even if you have no income, you'll still need some amount of income to consume. You still have to consume things like food, amenities. You still have to buy stuff. We're in a high consumption based economy. So if you're not working, if you have no disposable income, which comes from your wages and so on, you still need to buy things and services. So think about, for example, the people that are unemployed and are not registered as unemployed and are just asking for money. They still need to consume. They still live, so they have consumption CO. They have autonomous consumption. Your consumption that comes out from something else other than income. And we're looking to see what's marginal propensity to consume. Marginal propensity to consume is the marginal propensity to consume based on the changes of your income. More specifically, is the ratio of your change in consumption to a change in disposable income. Every time our income changes, our consumption also changes. So marginal propensity to consume is, are you more propense to consume when you have more income? And if so, how much does that consumption changes? So think about, for example, there's an all-time saying: the more you earn, the more you spend. The more you make, the more you spend. So your income actually changes your consumption. So if you experience a change in consumption and income, there's a high possibility that your consumption is going to change. So marginal propensity to consume (MPC) estimates a ratio of how much you spend for an additional extra dollar of income, if you put it in simple terms. So if your income rises from like $10,000 to $30,000, what's your marginal propensity to consume of the extra income obtained? And YD is your disposable income, your net income after taxes. So as mentioned, your autonomous consumption is the part of consumption that is independent of income. Sometimes you have to consume, and you may have other sources of income, other sources that allow you to consume, but not necessarily your disposable income, which is traditionally wages. Okay, so suppose we have the following information from 2009, several years ago, and the best estimate of the average household autonomous consumption spending was $17,594. This is how much money people spend regardless of their income. This is how much they need to spend, especially in the US, for example. This is based on the US. And the best estimate of their marginal propensity to consume is 0.51 or 0.52. Basically, they spend 52 cents to the dollar. If you earn one more dollar, they will spend 52 cents out of that dollar, if you look at it in that perspective. So your consumption function, C, is your consumption. Part of it is autonomous. This could be, for example, credit cards, family giving you money, whatever that $17,000 come from. Think about you as a college student. If you're not working, If you're not full-time employee, part-time employee, then your net disposable income is from your wages, right? So this will be gone. You still spend $17,594. From where? Maybe financial aid, maybe family stipends, something else, your autonomous consumption. So we're going to fill in this information. So we get our autonomous consumption, 17,594 is our autonomous consumption that comes from other sources besides income. 0.518, which is your propensity to consume. And if we have our income, we can plug it here and estimate our total consumption for that year. So if we have our income at 50,000, then we will consume out of those 50,000 net, we will consume 0.52 and add it to our total consumption for that year. And if your income rises, your consumption rises. So we're going to have something like a consumption function that is upward sloping. So suppose here we have in year one, Adam, college student, he earns $10,000, working part-time, and saves $1,000 a year. In year number two of college, Adam gets $5,000 raise. Maybe he's working more hours, he got a higher pay, and he earns a total of $15,000. And out of those $15,000 now, he saves $2,000, so he saves a little bit more. What is Adam's marginal propensity to consume out of the $5,000? This is $5,000. Out of the $5,000 raise, well, we need to calculate the change in income. It went from income one at $10,000 to income two now is $15,000. The consumption, well, out of those $10,000, he was saving $1,000, so he was only consuming $9,000. So we have consumption was $9,001. With more income, he's making $15,000. He's saving $2,000, so he's consuming $13,000. So the change in consumption is going from $9,000 to $13,000. So his consumption went up by $4,000. And the change in income, well, his income increased by $5,000. So again, this is $5,000. So he has a $5,000 raise. $5,000. So his change in income went up by $5,000. Okay, $5,000. So we have change in consumption divided by the change in income. That's 0.80. His marginal propensity to consume is 0.80. For those extra $5,000 income raised, he's going to spend 0.80 or 80% of that. And the rest is going to be saved. So that takes us to what's MPS, well, marginal propensity to save. So you can either do two things: consume or save. This is the assumption. So if you're consuming 0.80 or 80 cents to the dollar, what happens to the remaining 0.20 or the remaining 20 cents? You save it. If you consume 4,000 out of the extra $5,000 that you get, well, you're consuming, if you actually want to multiply in percentages, 80% of that, and the rest is safe, which is 1,000. You say 1,000, and 1,000 over 5,000 is 0.20. That's marginal propensity to save. Are you saving that? Well, it's a different story. Sometimes people save it, sometimes people give it away, or depends on what they do with this. But this is marginal propensity to save. So with the Keynesian model, we're able to approach the economy from different perspectives. Consumers are either spending the money, saving the money, investing that money, or not saving at all in some cases. So the Keynesian model allows us to see also that if you're saving, then you have a marginal propensity to save. The ratio of the change in your level of savings to the change in income. And sometimes it happens that when people make more money, they save more. But in other situations, when people increase their income, they consume more. So their marginal propensity to save is low. But if your marginal propensity to save increases as your disposable income increases, then you may be saving a little bit more. So marginal propensity to save, MPS, is equal to the delta change in savings, your change in savings, that occur when your income changes as well. Your income changes. So another important factor that we have to consider is the multiplier effect, or the multiplier process. And the multiplier in economics is the number that is multiplied times any increase in spending. Meaning that in the economy we have what is called a multiplier effect process. A multiplier effect process. Every time we spend on goods and services, our consumption triggers an economic effect. So think about, for example, you as yourself or me as myself. If we go out to the store and we spend all of our income or our propensity to consume, when we consume, we buy goods and services. That's multiple one, or process one. That consumption creates income for the person that's working, and it creates revenue for the business. When the person gets income, that person is going to consume some of her income. That's multiple two, or process two. That person, where that person goes to consume other goods and services, is going to create another effect. So basically, it creates a multiple transaction mechanism. Our consumption stimulates multiple transactions in the market, and it continues taking place. So the multiplier is essentially every time we consume, our consumption multiplies itself in the market, triggering multiple consumption process. And at the end, we get the total spending that happens in the economy when we consume goods and services, or when we spend goods and services, or when we invest goods and services. There is the consumption multiplier. There is the government multiplier when the government invests in the economy, for example, or injects financial stimulus in the economy. There's the investment multiplier when investment increases. Essentially, it's the multiplier. It triggers multiple economic expansionary effects. So the multiplier is crucial, and the multiplier is defined here by equivalent to 1 over 1 minus MPC. The multiplier is 1 over 1 minus MPC, which means just 1 minus your marginal propensity to consume. So we find this by doing the calculations, the change in consumption divided by the change in income. Plug that number into this and we'll find a multiplier, because this is how much multiple effects this is going to occur in the market. So we have an equation and also the intuitive understanding. The more people spend, the more the economic activity triggers multiple cycles of economic transactions. And we can actually find out, if we spend thousands, how much it's going to generate in multiple economic transactions. But through economic calculations, which include the multiplier formula or the multiplier equation. So here we have the formula for the economy that can actually change in economic gross domestic product levels if we change our spending. And keep in mind that our spending can increase or our spending can decrease. The multiplier can expand and the multiplier can contract the economy. If our spending is low or if it declines, what happens to GDP? It declines. If spending increases and we have a high multiplier, gross domestic product, which measures economic activity, it will increase as well. So it's important to keep this in mind. This formula is crucial. The change in gross domestic product in the economy will be equivalent to the multiplier, which is 1 over 1 minus MPC, times the change in spending. And change in spending can come from consumers, from the change in investment spending from the investors, change in government spending. Things can happen in the economy. And this is where Keynes is really coming into practice. If the government increases stimulus spending in the economy, like it happened in 2019, what will be the effect in the economy if we know our multiplier? Let's consider this. The United States is a significant, massive country, one of the best in the world in terms of size and scope and also of economic activity. The world consumption is also quite significant. This map shows the level of consumption that takes place if it's red or more purple, like in this case California, Texas, the center part of the United States, the north part, New York, for example. It means that we're high consuming states. And if we have our income, we also have other sources to spend, like credit cards. So we spend a lot using our credit card here in California. So the average person has about $3,000 balance and their credit card. Because remember that autonomous function that I gave you? Your income can only satisfy so much consumption, but if you continue consuming over your income, then you have to use something else like a credit card. So please make sure to limit your credit card spending, because you have to pay back with interest rate, and it's not 8%, it's not 10%, sometimes it's 14%, sometimes it's 15%, sometimes it's 20% or more. So keep that in mind when you spend a lot with credit cards. California is high spending credit card debt, and the East. Okay, good. Let's look at the multiplier and how it affects economic activity. Anytime there's a change in autonomous spending or a change in consumption or spending in general, it's going to create a greater change in total spending in the economy. If you spend $1,000 during this holiday season, and if everybody spends $1,000, everybody has some income. If everybody goes and spends their stimulus checks, it's going to create economic activity. People are going to be working. People are going to receive income. The businesses are going to have revenue to make more products, and so on. It creates a greater change in total spending. So in the simple Keynesian model, the change in total spending is equivalent to the change in the real gross domestic product in real terms in real GDP. And this is assumed because we have prices that are stable, a constant stability of prices, and we can reach natural capabilities of the economy, natural GDP. So the multiplier could take some time to take effect in the economy because it goes through multiple expansion channels, but it does have an effect. It takes a significant effect in the market. So let's take a look at the U.S. economy. We can probably also do the spending multiplier for the holiday season. But here we have the U.S. economy. And this is more or less a real-life example that happened in this year, 2000 COVID crisis, the 2019 COVID crisis. Well, we're in 2020. We're going to move forward, but the principle applies. The U.S. government increased spending, in this case, by approximately $725 billion due to the current economic crisis. Assume that the marginal propensity to consume is 0.81, meaning that consumers are going to spend 81 cents to the dollar of that fiscal spending. What is the change in GDP due to the fiscal stimulus, and use the multiplier equation and essentially find what the multiplier is. So we have our formula, the change in GDP in the economy, and goodness, I switched this. We have 725 billion here. There's a change in spending, 725 billion, to just go straight to formula 2. This one, 725 billion, and we have our multiplier, 1 over 1 minus MPC. We plug in the 0.81 here, 1 over 1 minus 0.81 meaning the MPC is 0.81. So I don't know why this 650 billion is there, but here we have 725 billion times 1 over 1 minus 0.81. 1 minus 0.81, and that will give us 5.26. 5.26 times 725 billion, that will give us a change in GDP of 3.8 trillion, approximately 3.8 trillion. That means that the economy is going to create a stimulus. That's why it's called a stimulus package. You're supposed to stimulate the economy, was to stimulate economic activity. The government injected 725 billion into the economy, and it's going to create a multiplier expansion process. So everybody's expected that their income is going to be used, the fiscal stimulus is going to be used, for example, to pay the mortgage, pay the rent, buy groceries, goods and services, etc., pay their bills. That's going to generate multiple transactions, which is the multiplier process. And essentially, it's going to stimulate the economy here, hypothetically, by $3.8 trillion to get it out of the crisis. And the multiplier is 5.26, meaning that this 725 billion, so we just plug it into this equation, ignore this one. Or for practice, you can you can actually calculate what the change in GDP will be if the stimulus was even lower at 620, at 650, just 75 billion less. You will see that it will be a lot lower. The bigger the spending and the bigger the multiplier, the bigger the multiplier, the bigger the change in GDP, or the bigger the economic expansion. The multiplier here is 5.26, which is calculated by the formula. Plug in the numbers and we'll get the total effect in the market. The multiplier, graphically illustrated, shows how it affects aggregate demand for the aggregate behavior of the economy. The total behavior of the economy is represented by aggregate demand. So an initial increase in autonomous consumption, here we have autonomous consumption, is represented by the movement from A to AD2 and AD3. So here we have aggregate demand, which is consumers, investors, government, the price level on the vertical axis, real GDP on the horizontal axis. If we increase the consumption here from AD1 to AD2 by 40 million, here by 40 million, the curve doesn't end exactly at AD2. This is the initial increase in consumption. Again, aggregate demand is consumption by consumers, investors, and government. Let's say that the total consumption is increased by 40 million from all of those sectors, right? Autonomous consumption by 40 million. It's not going to just shift by 40 million to AD2. It's going to increase to AD3, which is in this case an expansion of 160 million more to AD3. So for practice here, you can actually see what's the multiplier. Well, 40 million created an additional 160. So the total change is 200 million. So what's the multiplier here? What could be the multiplier? The total change was 200 million. We spent 40 million. What's the multiplier? Well, if it created 200, we have a multiplier of 5. 5 times 40, 200 million. The multiplier, the bigger the multiplier, the bigger the expansion. The smaller the multiplier, the smaller the expansion. And for like a country like US that is a highly consuming based country, think about that we have a significantly high multiplier. Sometimes that may change. So the Keynesian model explains the supply curve in different ways than the classical perspective. The price level is assumed to be constant, or stability of prices. So therefore, the Keynesian aggregate supply curve is going to be constant, horizontal for the most part, and then increase after a certain point after the adjustment process. So we're going to have a horizontal section on the supply curve on the Keynesian aggregate demand, aggregate supply model, and an increase in autonomous spending or an increase in aggregate spending in the economy will stimulate the economy and increase the level of GDP and may potentially keep the price level constant, but if it's on the upper part of the model, it can increase the price level in the long run. So let's take a look at the model. The aggregate supply, represented by the aggregate supply curve, green, here the green horizontal curve that looks like an L, is constant. And then it increases in the long run. Notice how it's vertical. It can actually sometimes be upward sloping and then completely vertical later on. So the aggregate supply in the simple Keynesian model specifies this. If the economy is in constant prices in the short run, here in the short run, prices are constant. In aggregate demand, AD1 is represented by AD1 in the economy, price 1, quantity 1. And there's a stimulus package that is implemented, and we're not yet in long-run equilibrium here, Q.10, long-run natural equilibrium GDP. The economy can be stimulated from AD1 to AD2 here. So aggregate changes in the horizontal sector, if the economy is underperforming below natural GDP, and there's a stimulus package or an increase in spending, you can increase aggregate demand. And the price level, you can increase output from Q1 to Q2. Output would increase all the way to the natural level of GDP and still maintain the price level constant. But any changes once we have reached this corner here with aggregate demand, any changes thereafter, if you stimulate the economy through aggregate spending, you're no longer going to increase the level of GDP above natural rates. You can increase aggregate demand, but you're going to have an inflation pressure by pushing the price level up. So technically, aggregate demand increases should only happen on the lower part or the horizontal part of the model to keep stable prices and reach long-run natural GDP equilibrium on this corner right here. Anything above that, above the horizontal section on the vertical aspect, aggregate supplies in the long-run behavior, vertical section, and increasing aggregate demand to aggregate spending is only going to increase the price level and not the GDP. That's an important implication of when to use Keynesian applications and when to not. So the economy, if it's in a recession, the economy here, Keynesian believed that the private sector and the business household sector combination might not be able to move the economy on their own out of a recession. It's possible, but it could take a long time. The private sector needs further stimulus from government, and households need some form of government stimulus as well. So the government should play a major role in stimulating economic activity. So Keynes argue, and also Keynesian economics in general, argue that during economic instability, during economic crisis, economic recessions, it is the responsibility of the federal government, state governments, and local governments to intervene and stimulate economic activity through adequate and responsible economic, public, and fiscal policies to increase aggregate demand because it has a significant effect. If you leave it alone, it could self-correct itself, but it could take a long time, and the public and businesses often cannot wait that long. You have public unrest, public concerns arising if you leave it alone. So government should do more. So here we have the model again. But this time we're going to focus on the private sector. So the economy is at point A here in equilibrium. This is the Keynesian model with the horizontal supply curve and the vertical supply curve. Price level is constant, meaning they stay the same. If we are at point A, aggregate demand, AD, it's indicating equilibrium Q1 at the price level 1. It's below the natural capability of the economy, QN. So the economy is below QN. Basically, this orange aggregate demand curve has to be right here, intersecting point B. But we are in a recession gap, according to the model. So it's producing less than the natural economic abilities. The question is whether or not the private sector can resolve the economy out of the recession on their own to shift the aggregate demand to the right, meaning because aggregate demand here consists of consumers, investors, government sector, and it also consists of NX, the international sector, but Keynesian excluded the international sector for a while and then later on brought it in. But here we're looking at consumers, investors, and government at the local economy, at the aggregate level economic activity. If we have strong investment, aggregate demand is equal to C plus I plus G. If there's strong investment, aggregate demand will shift slightly. If there is significant investment, it could shift to significant if the economy responds a lot. So sometimes it could improve it, sometimes it would not. No matter how low the interest rates are or how much investment has been generated by the private sector, the private market, aggregate demand is stimulated by consumers, investors, and government, all of them combined. So the private sector may not be enough to stimulate the economic activity, although it does start the shift to the right to close off this recession. If they continue to investing, so government has to do a little bit more. The Federal Reserve has to do a little bit more, and so on. So the theme of the Keynesian model is very simple. The prices remains constant until we reach natural GDP. The aggregate demand curve shifts to the right through either changes in consumption, which is C, changes in investment, or changes in government. If you want to stimulate your macroeconomy. If you bring the international sector, we can add it in also. the economy, it's possible that we could have an equilibrium during a recession. Basically, the economy has contracted and it has stayed there. It has stayed in a recession indefinitely, but that's difficult. Sometimes the private sector could stimulate the economy out of a recession, but it's not strong enough to do it on its own, unless it's quite significant increase. So the government may need to do a little bit more in managing the economy and stimulating the economy. Again, this is strictly from a Keynesian economic perspective. There has to be a balance. There has to be a responsible, accountable balance between the market, the private sector, the citizens, and public official, which is the government, to steer the economy to a greater level. Sometimes there's conflict of interest in either, or there's different views, but things happen. So let's take a look at the Keynesian model. The aggregate demand, which is represented by the red curve, covers the consumption by consumers, the investors with the private sector, and government in the public sector. They can, if there's an increase in consumption, an increase in investment, an increase in government spending, aggregate demand increases. That increases aggregate real GDP. The aggregate supply curve is represented by the horizontal green and upward sloping, vertical sloping aggregate supply curve. So in this model, we have a flowchart of how it explains economic activity as well. So we can either graph this in a way that it's sequential or in the chart, or we can also illustrate this graphically in Model B, which is a diagrammatic exposition of the ADAS model and its framework. Okay, now we're going to introduce a very well-known, a little bit complex, total expenditure framework model. The total expenditure framework model, TE, explains the total spending that takes place in the economy and the total production that takes place in the economy. The economy may be in either of three potential possibilities. The total expenditure framework, or often referred to as the TP framework, explains that businesses could produce more than necessary, can produce too much. So TP will indicate if the total production is greater than the total expending that's taking place to buy that production, when businesses overproduce and flood the market, or business can be producing significantly less or little, and total expenditure is greater. Consumers are buying everything and businesses are not producing enough, or businesses can be producing the right amount, where the total expenditure that takes place by consumers, businesses, and government, in the international sector, it's equivalent to the total production of goods. And according to many economic analysis and many economists, if the economy is operating somewhere below total production or above total production, both states are considered a disequilibrium. It is another way to look at a recession or an inflation period, and eventually may move to an equilibrium point and reach long-run equilibrium. So this model is graphing the Keynesian model in a different perspective, in a different analysis, in a different framework. To move from disequilibrium to equilibrium, different things need to happen. Businesses need to hold inventory to satisfy excess spending or excess demand. So sometimes consumers buy a lot of goods, and businesses have inventories and they decline those inventories to meet that demand. But in often cases, they don't know how much inventory they need to have, so they may overstack or understack the inventory against unexpected changes in demand. So think about when you go out and buy shoes, for example, to a warehouse shoe sale or shoe city. If you ask for your shoe, they have a warehouse on the back where they store boxes of shoes, right? So sometimes people rush into the store and buy all of the shoes, and sometimes nobody goes into the store. So it's possible that your total expenditure could be less than the total production, and businesses overstack and overproduce, and there's excess production that is added to the inventory. It just sits there. So real GDP, or the production, needs to slowly decline to make sure that is balanced, and total expenditure and total production are equivalent. And sometimes total expenditure, consumers are just buying everything. So think about this year during the crisis. People rushed to the stores, the grocery stores, to buy all the food, all of the amenities, all of the necessities that we needed. Right? Total expenditure increased above the productive capabilities for that short time frame. The businesses were not able to keep up with the excess expenditure, and inventory started to fall. Aisle shelves were starting to get empty, and businesses needed to increase production of goods to make sure that they filled back the shelves, or their inventory started to be used to satisfy demand. So, in the production of goods measured by real GDP needed to increase. So ultimately, we need to stabilize the economy. The economy turns to go back to equilibrium over time, but sometimes it takes some time to go back to equilibrium. So let's model this in the total expenditure economic framework. This is often referred to as the Keynesian cross because it looks like an X. I'll call it the X Wolverine, because we have the 45-degree line, and then we have the aggregate total expenditure line. So let's explain this step by step. So the economy at point E is in equilibrium, where your total expenditure, represented by the total expenditure purple line, TE, covers consumer expenditure, investor expenditure, government spending, and later on it's going to cover also the international spending. And the level of prices here, total expenditure is 10.7 trillion, and the level of GDP consumed is 10.7 trillion. The 45-degree line indicates the total production of goods. Again, the 45-degree line is a perfect 45-degree line right in the center. It's the total production. It represents the total production of goods at all levels. So here it's when total production is equivalent to real GDP. So total production here is equivalent at real GDP. If this line, the purple line, it's moving at the same direction of total production, will always be in total production will always equate total spending. From here, the economy can move either to the left, right back down here to less equilibrium, or to the right with another equilibrium. So let's start with point E at 10.7 trillion level of GDP, real GDP, where total expenditure and total production of goods is 10.7. So the production of goods by businesses and the consumption of goods by the consumers, TE, consumers, investors, and governments, are all equivalent. But what happens if we are at Q2, where the total production is less at 10.4? Again, total production is less, and the total spending is significantly greater at 10.6. Well, this results in what we call, this is equilibrium 2, an unexpected, your spending is greater than your level of production, so businesses have to increase their production and meet that spending with inventories. So it's signaling firms that they have underproduced products. The economy is underproduced because your total production, measured by real GDP, is less than your total spending. Consumers are spending more, and you cannot meet that spending. So here we have what is called like a recession gap. It's another way of looking at a recession. Your level of output is less than your level of consumption by the consumers, and we have underproduced. Inventories are declining. So you need to increase your level of real GDP to go back to equilibrium. So here total spending is greater than total production, and we are underproducing, inventories are declining, business production needs to increase. If we go to the right at Q1, the production of goods, total production is 11, but the total spending is below the total production. Again, the line. The line represents the total production of goods and services that is equivalent to real GDP. Any deviation from this 45-degree line means that total production is greater than total spending, meaning that consumers are underspending. And we need to increase the. We need to slow down the production. We need to increase spending and decrease the production. So at Q1, total expenditure is less than total production, resulting in an unexpected increase in inventories. Inventories are piling up, consumers are not buying, and firms have to cut production or undercut production in order to go back to equilibrium. So when the line is below the 45-degree line, it indicates that your spending is less than your production capabilities, and you may decrease your production back to equilibrium. In this situation, you're in an imbalance scenario. The economy needs to go back to equilibrium levels. And this Keynesian cross is important because it's another way of modeling the economy. The total spending takes place from all sectors, the consumers, the investors, the government, and at point E, the total spending is equivalent to the total production in real GDP. And keep in mind that this total spending considers the total consumption of goods and services. Our consumption function is included here. If our consumption is below, businesses are not selling their goods. The total production of goods is just piling up. Think of all the inventories of the cars. I always refer to as the dealerships that have a lot of cars on their lots that are sitting there empty and nobody's buying them. Total spending is below total production. And the other one here is when your total spending, everybody's rushing to the store and buying the products, and there's not enough available, like the grocery example. So the economy can be in either one of those directions, but the idea is to always be more or less around equilibrium, as close as we can to equilibrium levels. So here we are in the model in the economy when we're representing a recession period, and the economy is expected to be in this equilibrium at this point. So the economy in equilibrium should operate here at point B, where the quantity for the natural level of real GDP intersects the total production of real GDP on the 45-degree line. So using this total expenditure and total production framework, we see that the economy is currently in equilibrium point A, where it intersects the 45-degree line down here, below natural abilities. So the economy is in what we call a recession. In a recession, the natural ability of the economy is to produce at point B, so a little bit higher, but it's underproducing and is considering and is actually in a recession. The economy is in equilibrium at point A, at which point A is a low equilibrium. The economy is producing output that is closer to zero, and it's below the natural abilities. The natural level of GDP is greater than the actual level of output produced. The economy is in a recession, so the gap between point B to point the expenditure model is considered a recession situation. The other one, I'm sorry, this one here, this will be the recession where you're under consuming the output that is being produced, under consuming. The other one is you're over consuming the output. So here we have the situation where we are in a recession, the recession model using the TP, total expenditure framework. Another way to graph a recession situation. So the simple Keynesian model and the total expenditure framework, the economy could be in a recessionary gap, and the role of government is to stimulate the economy through fiscal policy. The economy could be below equilibrium, above equilibrium, or right at equilibrium. If it's at equilibrium point A, the economy is producing an equilibrium quantity, and the natural level of GDP is equivalent to the level of output. If the economy is producing a real GDP that is less than the natural GDP, is officially in a recession. And how long does the economy take to get out of a recession? Well, the quicker policymakers and elected officials recognize where the recession is coming from and what's inducing or creating the recession, the faster the economy gets out of a recession through adequate fiscal policy or economic policy. If it takes a long time, the recession could last 6 months, 9 months, 12 months, 18 months, 24 months, but most of the time recessions tend to be mild. From time to time, we get significant recessions that last an entire year. So thank you, everybody. We're going to conclude with the model that we analyzed earlier, with the total expenditure model. If you remember, this model looks similar to the aggregate demand model. That's because they are related. It's another way the Keynesian introduced the economic analysis using the total expenditure framework. Total expenditure comes from consumers, investors, and government. If consumption increases, investment increases, government spending increases, total expenditure increases, real GDP increases. If real GDP increases, this output is going to shift to the right, and the total expenditure will shift up. This model can shift, by the way. This is important for the assignment. If investment or consumption increase, the total expenditure line will shift up, and that will increase the equilibrium to a new point, increasing the level of real GDP to the right. So we're represented as a flow chart or also as a graphical illustration. And for the 45-degree line, it's the level of output of real GDP produced in the economy. So keep that in mind. If government spending increases, total expenditure shifts up. If investment increases, total expenditure will shift up. If consumption increases, total investment will if consumption increases, total expenditure will increase, and it shifts up. Thank you, everybody, for joining the session. Have a good afternoon. Enjoy the rest of the day, and I'll see you next time.